We heard there about a lot of sustainable practices that create opportunities for credit union. It's been the theme of the day so far. We're going to explore that idea a little bit further now. I'd like to welcome to the stage Jim Scott, Senior Advisor of Financial Institutions at Ceres. In Jim's role with the Ceres Accelerator for Sustainable Capital Markets, Jim works to enhance the resiliency of US and global capital markets by advising banks, financial regulators, and other systemic actors on sustainability and climate risk management best practices. Hello, Jim. So glad you could join us. Take it away.
Good morning. Good morning. Thank you very much for that very kind introduction. And thanks all of you for joining us here in person and virtually. I'm trying to point to the camera there. So that was a fantastic presentation. They left off with how do we speed things up? How do we make the rubber get rubber meet the road? How do we get things in action? That is what I plan on talking about today. So perfect segue, whoever organized the speaking, perfect segue. By the way, if I can just take a minute, right before the presentation started, I was reminded that the credit union crowd is a fun-loving bunch and that I should open up my presentation with a joke. So bear with me here as I do that. My presentation, I talk about sustainability so much, it comes up so often in my presentation that, when I was reviewing my notes, I bought a thesaurus app thinking I would find different word choices. But this thesaurus I bought must have been the worst one I could find. Not only was it terrible, it was also very, very terrible. So that's what you get when you have ChatGPT write your jokes for you. Okay, great. Thank you. For those of you not familiar, Ceres is a US sustainability nonprofit with over 30 years of experience working on climate change and other sustainability issues. We are an advocacy organization, not an activist one. In fact, like all of you, we want to ensure that the credit union system remains resilient and able to provide world-class financial products and services to all of its members. To set the stage for today's chat, I want to talk about the exciting and transformative change that's happening in the US right now and the global economy more broadly. The low carbon economy. To be clear, and this is a popular misconception, the low carbon economy is not a low growth economy. On the contrary, the low carbon economy is an innovative and highly productive economy, but one with business processes and products that generate significantly lower negative externalities. So, for example, GHG emissions. And it's this shift away from high emitting businesses and towards the financing of climate adaptation and climate resilient technologies that present such a compelling opportunity for all of us in the room and online today. So how much of an opportunity? Well, the transition to a low carbon economy will require a massive amount of spending and investment, as we all know. By some estimates, as much as $275 trillion. So whether your credit union serves individuals, small businesses, or large institutions, the transition will unlock a tsunami of financing opportunities for the credit union industry. So that begs the question that I get asked all the time, when will this transition become real? When will it start? When will this business as usual stop and the time of transition begin? Well, good news. By most measures, the tipping point, if you want to call it that, to a low carbon economy has already been tipped. In 2018, for every dollar invested in fossil fuels, $1 was invested in clean energy. However, today, for every dollar spent on fossil fuel technology, $1.70 is spent on clean energy. So again, today's discussion is not focused on how can sustainable finance help credit unions in the far off distant future, but rather how can sustainable finance drive opportunities for your members today, now that the transition to a low carbon economy is well underway. So what is sustainable finance? Sustainable finance, simply put, means that your credit union is actively supporting and working with its members to help them meet their sustainability goals. So for example, that might involve providing members with financing for nature, human capital, or climate solutions, or providing members with new financial products that, in addition to providing a financial benefit, also provide members with a sustainability linked benefit. And let's explore both in a little bit more detail. Okay, climate solutions. So a lot of taxonomy here, a lot of definitions. I think it's important for us to level set and get on the same page. Climate solutions are what we call the new technologies and infrastructure that your members will want to adopt. So these are things that will help them lower their carbon footprint, reduce costs, and make their operations more resilient to climate-driven physical and transition risks. In many cases, these adaptation technologies will be very capital intensive, and so financing will be required. So for example, the financing of solar and wind power infrastructure for residential or commercial real estate, or the financing of renewable transportation like personal use e-bikes and EV automotive vehicles, or a fleet of electric delivery vehicles. Several credit unions, as I'm sure most of you know, are already providing climate financing for climate solutions. And as demand continues to grow, so will the opportunities for other credit unions to get involved. Climate finance products. Again, like lending for climate solutions, these new products are designed to help your members meet their sustainability goals. However, here you're not financing third-party technology, but rather your credit union is building new financial products that provide, again, traditional financial utility while also facilitating sustainability goals. And again, there are some examples of this already out there in the credit union space. Some of them are zero emission investments, sustainable deposit products, carbon neutral credit cards, and green mortgages. And again, I just want to keep re-emphasizing this so that we all understand this is a huge amount of investment going into this space. Sustainable finance is not some philanthropic activity, right? I mean, this is very important to understand. The size of the prize is huge. In the US alone, sustainability legislation like the IRA has led to 270 billion in capital investments and a boom in high-paying climate tech jobs. And this presentation, along with the report I wrote on this topic, which was released last week and is available on our Ceres website, is to make sure that no matter where your credit union is on the sustainable finance opportunity ladder, we want to make sure that everyone is able to access this gigantic opportunity for the benefit of your members and your community. Equally, we want to make sure that your credit union is not blindsided by the climate crisis, which is already upon us, let's be clear. This year alone, the US experienced 23 separate billion-dollar climate disasters impacting every corner of the country, as we heard from the last panel discussion from our friends from Hawaii. Now, this is from the NOAA website. Here's a reinterpretation of this data, taking historical data into account. In the 1980s, the US had $1 billion disaster every 75 days. Pretty bad. In the 2020s, there's $1 billion disaster hitting us every 18 days on average. So the data, again, is very, very clear. Whether out of necessity or otherwise, your members are going to need climate solutions financing and climate financial products to help them deal with this. And again, just to bring this home and make sure we hit all of you in the credit union space clearly here, as you can see from this statistic, more than 60% of all US credit unions are exposed to a significant level of physical risk from climate change. So for many of you in the audience, virtually and in person, taking advantage of sustainable finance is both an opportunity for enhanced resiliency as well as for new growth opportunities. Okay, quick pause to take stock of where we are. We've reviewed the need and the massive opportunity available from sustainable finance. So how exactly do you go about building out or enhancing your sustainable finance strategy? This is taken from the report that I mentioned that I co-authored, which has been released recently on the Ceres website. I'd invite anyone who's interested. We're going to go over this at a very high level today, given the time we have. But if anyone's interested in digging into this, please reach out to me directly and we can chat further. Okay. The first step is to assess where your credit union is on this sustainable finance opportunity ladder. After working with several banks and credit unions, we found that there are really 4 stages of opportunity. Step 1, which is priming your credit union for the transition to a low carbon economy. This is where you develop strategy, update policies, and make sure you have the right in-house capabilities such as staff, consultants, etc. Step 2, engaging members with the development and provision of new climate finance products, which we've just talked about, which again, a number of credit unions are already doing. And we'll talk about that a little bit further in this presentation. Step 3, deploying your credit union's low carbon transition plan. If you don't have a transition plan, you're not at step 3. If you are, then you have a plan that involves the financing of new climate technologies and ensuring you're able to de-risk your own business activities. And then of course, step 4, fully optimizing your credit union for the low carbon economy. Not many banks or credit unions are 100% at this point yet, but this is the stage where your governance, public advocacy, and return metrics fully integrate sustainability goals and factors. Now, the reason we have this ladder, the further up the opportunity ladder your credit union moves, the more revenue and member benefits you'll see. And again, although this isn't the goal of this presentation, the further along the ladder you move, the more improvements in internal risk management you'll see as well. So let's briefly go over these 4 steps. And again, as I mentioned earlier, credit union preparedness on this, our research has shown, is by and large limited right now. Okay, step 1. This is where you harness and organize your existing internal resources to take advantage of some basic sustainable finance opportunities. For some of you, this means developing your in-house talent to become more fluent in sustainability. For example, understanding the various standards, frameworks available out there, or getting third-party training in climate risk assessment. For others, it means adding existing staff, such as adding a chief sustainability officer, which again, many of you have already done. It could also mean lowering your credit union's operational greenhouse gas emissions, so what we call scopes 1 and 2. Or it could simply be looking at your members, your product offerings, and your lending activity to better understand your financial supply chain risks, often referred to as scope 3 emissions. Note that scope 3 emissions are often used as a proxy for your credit union's exposure to transition risk, also known as the risk that transition to a low carbon economy will negatively impact your members and your ability to survive and thrive. And as you can see from this slide, several credit unions and industry organizations have already made progress along these lines. So if you haven't already, I urge you to reach out to these industry peers for additional thoughts, sharing of best practices, and better yet, to see if they have steps on how you can all reach step 2. Step 2, for me, this is one of the more enjoyable steps. This is where your credit union comes up with fun, new products and services to help your members achieve their sustainability goals. So let's take a look at one thing here. EV lending. A recent Goldman Sachs report estimates that EVs will represent 50% of global car sales by 2035. Is your credit union positioned to take advantage of this massive growth? Or what about the massive growth in green mortgages and home equity lines of credit that promote climate resiliency? As proof, by the way, of the enhanced risk management benefits that I mentioned earlier, inherent in many sustainable finance products. I want to note that green mortgages have a 34% lower default rate compared to conventional mortgages, all else being equal. And as mentioned earlier, there are quite a few credit unions that are already seizing on these opportunities. A great example of this is from our friends at VSE-CU. They offer, among other things, green deposits, solar loans, energy efficient lending, EV lending, and even a mortgage designed to help you go off the grid. I encourage all of you to reach out to our friends at VSE-CU to learn more about these wonderful products, and obviously reach out to Ceres as well if you want to discuss further. Okay, now what we've just discussed may seem like a lot, but take comfort in the fact that there are plenty of third-party resources out there for credit unions to benefit from. Some of which I'm up here are from our friends who were just up on the panel earlier. You know, the way we think about it at Ceres is that you should be rest assured that none of you will need to make this journey alone. However, you will all need to eventually make this journey. And again, Ceres is always available to help. Step 3. Once you reach stage 3, you'll see the transformative impact of providing financial products specifically geared to supporting the transition. Data point for you. Last year, global spending on transition technology. So things like renewable energy, electrified transport, green hydrogen, carbon capture, et cetera. Basically all the technology we'll need to make the low carbon economy work totaled $1.3 trillion. This, and more interesting than that, I think, is the trend line, which shows that this figure is up 19% from 2021 and up 70% from 2019, 2020 not having happened at all, of course. And again, this is all the more relevant given our research that shows that 6 to 7% of all US credit unions face a high degree of transition risk as measured by their field of membership. Okay, step 4. The final rung on the opportunity ladder is probably the hardest stage for a credit union to reach. And to be honest, as I mentioned earlier, I don't know of any credit union that has reached it yet. I'd love to be proven wrong on that. But let me pick out a few points from step 4 that we can all use as a aspirational North Star to guide our efforts. Step 4, here is where your credit union's policy engagement activities, i.e. discussions with legislators or regulators, will align with all of your institution's goals, including sustainability goals. Here is where your credit union is vocal in asking for public and private investments in climate resiliency for the communities you operate in. And here is where your credit union actively supports and advocates for smart sustainability legislation like the Inflation Reduction Act that will help your members transition as quickly and cost effectively as possible. Now, all of this may sound obvious to all of you, but believe it or not, Ceres recently published an analysis of policy engagement by the financial sector. And although many of the people in that sector have well-established, well-articulated climate goals, a lot of them have yet to fully include their sustainability goals in the things they publicly advocate for. They seem to be at odds with each other, which just really doesn't make sense for anyone, stakeholders, members, anyone. So like I said, step 4 is low-hanging fruit, and if done properly, can yield large and quick gains for your credit union. Okay, I want to leave just a few minutes for questions. So let me just skip over parting thoughts. If I had to summarize today's content to a few sentences, I'd simply say that the climate is changing for credit unions across the country and for all financial institutions in the US for that matter. And whether your credit union chooses to be a leader or a laggard, or whether you consider climate change a near-term, long-term, or emerging risk, the language that our regulators like to use, is largely irrelevant. The era of business as usual member engagement, product development and risk management has passed. And for the benefit of your stakeholders, credit unions need to work their way up the sustainable finance opportunity ladder and take advantage of the massive commercial opportunities that are highlighted today. For those of you interested in learning more about this, please feel free to contact me. My email address is there on the screen. And thank you very much for your time. I think we have a few minutes for questions.
You've covered it too effectively, Jim.
I covered it too well. Like I mentioned, we do have
got
a
one.
guide that we recently published. It's a great report, sustainable finance opportunity identification for financial institutions. It's for banks and credit unions, and it's available on the Ceres website. Melinda, you have a question? I can hear you because you're close by, but I'm not sure the microphone's working. Yeah, absolutely. The question is, do we have case studies or other resources to help those who are laggards? And look, it's a great question. To be clear, we are not here to be prescriptive. We are not here to force anyone to do anything they don't want to do. I've heard, going around the country, going around internationally, I've heard a number of fantastic roadblocks that are preventing credit unions and community banks, large banks, from making the change that they know they have to make. And it's very, very understandable. These institutions, credit unions, et cetera, that don't rise to the challenge, look, it's their choice. And they have the right to go bankrupt like any other business has the right to go bankrupt. It's very sad, but look, that is unfortunately for those who aren't willing or able to adapt. The end game here is just very, very clear. Regulators are raising capital charges here in the US for all financial institutions. In Europe, climate and other sustainability factors are being taken into capital charges already. So for a number of people who have high risk operations, high risk lending, high risk business models, that's going to eventually translate to even more capital than what the Fed's proposing now for those institutions. I mean, how much more capital can you set aside against high risk assets and still deliver benefits to your members? Well, we all know the answer to that. So we're not here to, we do have tons of resources for those people, for those credit unions, for those financial institutions, once they decide to hop onto the opportunity ladder. But yeah, we're not here to force people to make the climb. Absolutely. Thanks for the question. Absolutely. So we work very closely with our good friends at the NCUA. The question was, how can we help them move faster? So we are providing resources to all the federal regulators. What I would say about the NCUA, though, is, again, like the OCC, like the Fed, especially the NCUA, they are very much focused on meeting the needs of their members, and they take a lot of, as we all know, member feedback into their decision making. They take member feedback into a number of things. The board, the 3-person board, listens very closely to what members are asking for. So when members are asking for, let's focus on cryptocurrency and all sorts of other fun and less useful things like that, they're going to really put that on the top of their agenda. So my suggestion to you would be, again, let's not try and prescribe to the board of the NCUA what they should work on. Let's have as many members as possible make their voice very loud and very clear as to what they want the NCUA to show leadership on. Like most regulators, when the members, when the credit union community rises up and makes it very clear that leading on climate change is important, they'll respond. In New York, a number of banks and credit unions in New York made it very, very clear to the NYDFS, the regulator in New York, that they wanted guidance. And shortly thereafter, the NYDFS put out world-leading guidance on climate principles for financial institutions in that state. Again, I'm very, very confident that as a very responsible regulator, as a very responsive regulator, when they hear that the credit union space wants that type of leadership, climate principles, I think you'll be surprised how fast they move in terms of providing that leadership. Yeah. Yeah.
Thank you so much, Jim. Ask and you shall receive is I think the short version of that answer. Thank you so much.